Imagine waking up tomorrow morning to find out that the price of literally everything you buy just doubled overnight. The gas in your car, the food on your table, the clothes on your back, everything. This is not some dystopian science fiction fantasy. Right now, in April 2026, the global economy is standing on a tripwire. The world's gas station is in a massive escalating brawl, and someone is threatening to blow up the pumps. President Donald Trump has issued direct, explicit threats against Iran's oil infrastructure. This is not just typical political noise. This is a direct threat to the very heartbeat of the global economic system. To understand why this is so dangerous, you cannot just look at a map. You have to understand the physical reality of a place called Karg Island. Karg Island is a tiny strip of rock in the Persian Gulf, but it is arguably one of the most important pieces of real estate on planet Earth. Over 90% of all Iranian crude oil exports leave from this single vulnerable island. It is the nerve center, the absolute bottleneck of their entire economy. Imagine a giant funnel where millions of barrels of oil are squeezed down into a tiny, fragile glass tube. That tube is Karg Island. If a military strike takes out the loading terminals on Karg Island, millions of barrels of oil vanish from the global market instantly. But the nightmare does not stop there. Karg Island sits near the Strait of Hormuz. The Strait of Hormuz is a narrow waterway between Oman and Iran. At its narrowest point, it is only 21 miles wide, but through this tiny sliver of water flows roughly 20% of the world's entire oil supply. Think of the Strait of Hormuz like the global economy breathing through a tiny drinking straw. If Iran retaliates by mining the strait or attacking commercial tankers, that straw gets pinched shut. The global supply chain would choke immediately. The price of crude oil would absolutely explode, sending shockwaves through every single country on Earth. This brings us to a terrifying economic concept that you need to understand right now. It is the anatomy of an energy shock. Tyler Goodspeed, a brilliant economist who previously served as the acting chairman of the Council of Economic Advisors at the White House, has explicitly warned about this. Goodspeed spent years studying the intricate, hidden webs that connect raw resources to the money in your pocket. His framework reveals a dark truth. Energy shocks are not just a problem for people who drive big trucks. Energy shocks are the absolute prime cause of major economic recessions. Why? Because energy is the base layer of civilization. Think about a simple plastic toothbrush. That toothbrush is made from petroleum. It was manufactured in a factory powered by natural gas. It was put on a truck that runs on diesel fuel. It was shipped across the ocean on a massive cargo vessel burning bunker fuel. It was driven to your local store by another gas-powered truck. Finally, you drove your car to the store to buy it. At every single stage of that process, energy is consumed. When the price of oil spikes because of geopolitical panic, it acts like a massive, invisible tax on literally everything that moves. It drains the disposable income out of the pockets of everyday consumers. If you are spending an extra $200 a month just to fill up your gas tank to get to work, you are not spending that $200 at local restaurants. You are not buying new clothes. You are not taking vacations. Consumer spending collapses. When consumer spending collapses, corporate profits collapse. When corporate profits collapse, companies lay off workers. That is exactly how an energy shock triggers a brutal recession. But it gets worse. A pure recession is bad, but a central bank can usually fight a recession by cutting interest rates to stimulate the economy. But an energy shock creates a completely different monster. It creates stagflation. Stagflation is the ultimate nightmare scenario for the Federal Reserve and the global financial system. To understand stagflation, we have to travel back in time to the 1970s. Back then, the United States was hit by a massive oil embargo from the Middle East. The price of oil skyrocketed. This created a horrifying paradox. The economy was stagnating, unemployment was rising, people were losing their jobs, but at the exact same time, inflation was exploding because the cost of energy was pushing the price of all goods through the roof. This is stagflation. Stagnation plus inflation. It is a terrifying trap. If the central bank tries to fix the high unemployment by printing money and cutting interest rates, they just pour gasoline on the inflation fire, making prices rise even faster. But if they try to kill the inflation by raising interest rates, they crush businesses, choke off borrowing, and guarantee a massive, painful recession. In the late 1970s, it took a Federal Reserve chairman, named Paul Volcker to finally break the back of stagflation. Volcker had to raise interest rates to nearly 20%. Let me repeat that. 20% interest rates. It intentionally threw the United States into a severe recession, destroying businesses and jobs just to wring the inflation out of the system. Today, if Trump's threats against Iran materialize into actual military strikes, we are staring directly down the barrel of a 1970s-style stagflationary shock. The Federal Reserve would be trapped in an impossible position, forced to choose between destroying the currency through inflation or destroying the economy through crushing interest rates. And if you think this is just a localized problem in the Middle East, you are missing the massive multipolar chess game happening right in front of our eyes. While everyone is distracted by the rhetoric aimed at Iran, Russia just shipped 100,000 tons of crude oil directly to Cuba. Let that sink in for a second. Russia is moving massive amounts of energy to an island, sitting just 90 miles off the coast of Florida. This is a profound echo of the past. Let us look back at the Cuban Missile Crisis of 1962. During the Cold War, the Soviet Union placed nuclear missiles in Cuba, sparking a terrifying 13-day standoff that brought the world to the absolute brink of nuclear annihilation. Today, they are not sending missiles, they are sending crude oil. But the geopolitical strategy is exactly the same. We are living in a multipolar world, where strategic rivals are constantly probing for weakness. Russia is exploiting the fact that the United States is currently distracted and overextended. By supporting Cuba, Russia is forcing the United States to look over its shoulder at its own backyard, while simultaneously dealing with a crisis in the Middle East and a war in Eastern Europe. Think of it like trying to play chess on three completely different boards at the exact same time while someone is actively kicking the table. This complex web of alliances emboldens adversaries like Iran. They look at the global board and realize the United States cannot afford a massive, prolonged conflict. This increases the chance that Iran will test American resolve, sparking the exact kind of miscalculation that leads to a catastrophic war. So how do we navigate this? The first thing you must do is separate yourself from the herd. Right now, the herd mentality is blinding people to the real danger. The consensus view, the average person watching the nightly news, is writing off these threats as just political theater. They see the Pentagon denying rumors about defense stock trading, and they assume everything is fine. The herd has become completely numb to Middle East tensions. They assume that rational minds will always prevail, and that everyone will just back down at the last minute. The herd is positioned for business as usual. But smart money, the real institutional titans of finance, they do not think like the herd. Smart money operates on second and third order thinking. First order thinking is simple. Trump threatens Iran, so the price of oil goes up a little bit. That is where the herd stops. But second order thinking goes deeper. Second order thinking realizes that the threat itself, even if a single bomb is never dropped, completely changes the structure of the global economy. For example, because of the elevated threat level, maritime insurance companies are suddenly panicking. If you are a massive shipping company, moving a billion-dollar oil tanker through the Persian Gulf, your insurance premiums just skyrocketed overnight because the risk of your ship being sunk is suddenly much higher. This massive surge in insurance costs acts as a hidden tax on the entire global supply chain. That is a second-order effect. Third-order thinking goes even further. Third-order thinking realizes that this sustained, elevated cost of energy and shipping will inevitably trigger that stagflationary impulse we talked about earlier, forcing central banks into that impossible dilemma and ultimately crushing long-duration assets like technology stocks, while making hard assets like gold incredibly valuable. This is exactly how legendary investors build massive wealth during times of global panic. Let us look at the philosophy of Sir John Templeton. John Templeton was one of the greatest contrarian investors in human history. He famously said that the time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. To truly understand Templeton, we have to go back to 1939. World War II had just begun. Hitler had invaded Poland. The entire world was descending into absolute darkness, chaos, and bloodshed. The stock market was terrified. People were panic selling everything they owned. But John Templeton did the exact opposite. He borrowed $10,000, which was a massive fortune back then, and he bought 100 shares of every single company on the stock exchange that was trading for less than $1. He bought 104 different companies, many of which were teetering on the edge of bankruptcy. Everyone thought he was completely insane for buying stocks during a world war. But Templeton understood something profound. He understood that extreme fear creates artificial discounts. Over the next few years, as the American war machine ramped up to fight, the economy boomed, and Templeton made an absolute fortune. Warren Buffett operates on the exact same principle. Be fearful when others are greedy, and be greedy when others are fearful. Right now, the market is anxious, but we have not yet reached maximum pessimism. True pessimism will arrive the moment a missile is actually fired. That is the moment the herd will panic sell everything, and that is the exact moment you must be ready to buy. We actually have a perfect historical blueprint for exactly how this plays out. We need to look closely at the lead-up to the 1991 Gulf War. In August of 1990, Saddam Hussein and the Iraqi army violently invaded the neighboring country of Kuwait. Kuwait was a massive oil producer. The world instantly panicked. The fear was that Saddam Hussein would continue marching straight into Saudi Arabia and seize control of the world's largest oil reserves. The price of crude oil absolutely exploded. It more than doubled in just a few months. The stock market crashed. Consumer confidence plunged. Everyone was terrified of a massive, prolonged war in the desert that would cripple the global economy for a decade. The period of uncertainty between the invasion in August 1990 and the start of the counterattack in January 1991 was excruciating. The market bled out for months purely based on the fear of what might happen. But then, on January 17, 1991, the United States and coalition forces launched Operation Desert Storm. The bombing campaign began. Missiles were flying. The war had officially started. Logic would tell you that the stock market should have crashed, even harder that day. But that is not what happened. The exact opposite happened. The moment the bombs started dropping, the uncertainty was instantly removed. The stock market actually bottomed out and began a massive, historic rally. The price of oil collapsed back down to normal levels almost immediately. The lesson from the 1991 Gulf War is incredibly counterintuitive but absolutely vital. The market always sells off the hardest on the rumor, the threat and the uncertainty of war. But the market almost always bottoms out and begins to recover the moment the actual conflict begins, because the worst-case scenario is finally known and priced in. So how do we practically apply all of this history and philosophy to your portfolio? Right now, you need a system. At Warm Insight, we utilize a highly resilient framework called the 50-35-15 seesaw. This is not about guessing the future. It is about preparing for any possible outcome. Let us break it down. 50% of your portfolio should be in broad, high-quality equities, like the SPY exchange-traded fund, which tracks the S&P 500. This captures the underlying unstoppable strength of the American economy. You never want to bet completely against human progress. 35% of your portfolio is your safe haven allocation. This is split between long-term United States Treasury bonds and physical gold. Gold is the ultimate historical hedge against geopolitical chaos. And currency devaluation? It has survived every war, every famine, and every collapsed empire in human history. The final 15% is the most critical piece of the puzzle right now. It is pure cash. This is your tactical reserve. This is your ammunition. In the current environment, with Trump threatening Iran and energy shock risks rising, we make a slight, calculated adjustment. We take a tiny slice, maybe 2 or 3%, and move it into the energy sector. We buy the XLE exchange-traded fund, which holds massive oil and gas companies. Why? Because if the Strait of Hormuz is closed and global oil prices double, these specific companies will make record-breaking profits. This single move acts as an insurance policy, a shield that protects the rest of your portfolio from the stagflationary fire. During global crises, you must also understand the concept of the global shield and the least dirty shirt. When missiles start flying and supply chains break down, global capital panics. Trillions of dollars instantly look for a place to hide. And where does it go? It goes to the United States dollar. Why? Because the United States is the least dirty shirt. In the global laundry basket, Europe is incredibly weak right now. They rely heavily on imported energy to survive. If oil prices spike, the European economy will be crushed. Emerging markets in Asia and South America are even more vulnerable. When the global economy gets scary, investors pull their money out of emerging markets. and run back to the safety of America. The United States has massive domestic energy production, the largest military on Earth, and the deepest financial markets. When geopolitical panic strikes, the U.S. dollar gets stronger. This dynamic means that owning American assets is vastly superior to owning international stocks during a crisis. Finally, you need mechanical rules to survive. The emotional roller coaster of a market crash. Human beings are biologically wired to panic when they see their life savings turning red. If you do not have a mechanical rule, your emotions will force you to sell at the exact bottom. This is where the 50% panic rule comes in. It is a modified dollar-cost averaging strategy. You do not try to guess when the market will fall. Instead, you wait for a massive, terrifying catalyst. If a confirmed military strike occurs in the Middle East, and the stock market instantly plunges by 10%, your heart will be pounding. The news will be screaming that the world is ending. That is exactly the moment you deploy half of your 15% cash reserve. You automatically buy the panic. You buy the broad market at a massive discount. You do not buy single speculative defense stocks because those can collapse instantly if a peace treaty is signed. You buy the broad market. The remaining cash is kept in reserve, just in case the market drops another 20%. This disciplined, emotionless strategy ensures that you are acting exactly like John Templeton and Warren Buffett. You are turning the blind, irrational fear of the herd into your own long-term generational wealth.